I promised people I would talk about another REIT after last week when I pointlessly talked about a REIT that was being acquired and it was trading basically at the price it's set to be acquired at. So let's talk about Tritax Big Box, which we've, I think, mentioned on the show, but not really gone into much depth on the show before. So let's keep going with that theme. This is a UK-based warehouse REIT. Big Box here largely means industrial distribution and warehousing. And if you look at this company's share price over the last, well, I've got the max chart here on Google, but if you look at it kind of from shortly before the pandemic, it did more or less what these kind of things do, which is go down almost immediately because everything did. And then people started ordering stuff online and people were, this is great, no one's ever going to go into a shop again. And the thing went up an awful lot because demand for warehousing was very, very strong. And then it sort of came down the other side a bit, in fact, quite a bit. It's more or less undone its kind of post-COVID. It's kind of during COVID bounce, and it's now roughly where it was sort of beforehand, like most good REITs eventually do, level off. So what you saw was a kind of boom in warehousing, and it went up as a result, and then a kind of fall off in warehousing as the thing kind of got overbuilt a bit. And in the case of Tritax Big Box, you live with that. You kind of are fine with the idea that, well, look, you were there on the upside, so you're going to be there on the downside. What you don't live with this from is diversified REITs who decided to go getting into warehousing and selling off their other stuff roughly in 2022 when it was pretty much at the top and going downwards, not mentioning any names. But if you're British and you're into land, there's something to think about there. Okay, so what do we have here? We have a set of full year 2024 results that kind of interest me because they remind me a bit of why I'm slightly hesitant when it comes to REITs. I'm not above looking for opportunities there. I've talked about them before, and I think at the right price they can be very, very good investments. But what we saw from Tritax Big Box is a $3.5 billion pound. They're all UK stocks today. £1 billion company that generated net rental income of £276 million. That's not bad, and it's also up 24%. Which is very impressive because REITs don't usually grow much, if at all. They kind of mostly have inflation-linked contracts, so you get inflation-linked growth. And then you try and renegotiate them when the kind of contracts roll off and hope the tenants don't run away and hope you can charge them more. And if you have good assets, and you generally can, and if you have bad assets, and you generally can't. And it's quite hard to find out until you get to the point of renegotiating these things, and then you realise where you're up to. But 24% growth is very, very impressive, Steve. And the reason for that is they made a big acquisition of a company called UK Commercial Property REIT. Nothing unusual about that, attempting to grow by acquisitions. They are going to, or are in the process of, I think, divesting of some of what they consider to be the non-core assets, which is polite speak for the less good ones, as far as I can tell. And their dividend is up as a result of this giant gain by 4%. So 4% is your dividend growth for the year. The reason that you've managed to have net income go up, or net rental income, as they call it, net of I'm not quite sure what, but net of something rental income up 24% and a dividend up 4% when you're a REIT that's supposed to pay out 90% of your rental income, is because they've also had a 20% share count increase. And this is kind of the interesting thing with REITs. It's hard to finance growth. They are in a big spread business, and they've also had a 21% debt increase in long-term debt as far as I could see as well. So there's quite a bit that goes up to offset these enormous things, and to make a big step forward, you have to make a big payment as well. And the trouble is, if you try and acquire in your sector, your share price tends to be relatively low when other things in your sector is relatively low. It's not impossible for a company to screw it up and find their stock goes cheap, and it's not impossible for a company to catch a massive boost if they're massively charismatic, but that's not really how REITs tend to work here. Their current average cost of debt is about 3.5%, so you need to find something that's going to offer you a more than 3.5% return if you're going to take on debt to finance anything. And they have a dividend that's 5.4%, which means that if you're going to make any money on it, and you're going to do it with equity, you need to find something offering you a more than 5.4% return, and then your return will be the difference. And it's not super, super easy to go about finding these kind of opportunities, and the bigger you get, the harder it is. So a thing I often kind of see with REITs is that you really have to keep a close eye on, not in the way that I've done recently and screwed it up, which I'll come back to in a couple of weeks' time when we do Q1 portfolio reviews. you really have to keep an eye on share count. There are some share counts that go up an awful lot. And if you are just looking at things like net rental income and saying, this is great, it's up 24%. Okay, it's an acquisition, it's a one-off thing, but 24% is 24%. It's kind of not. It's 24%, and then you dilute that down by taking off 20 of it, and you've got managed up 4%. And up 4% isn't bad. Up 4% is better than down 4%. It's roughly in line with what Wetherspoon managed. But what you do kind of get is that's the REIT's idea of a big move, sticking out another 20% of your shares to push yourself forward in net terms 4%, which means you really have to catch these things with big yields. Tritax is currently at 5.4%. I'm not sure that's enough to get me interested in this, bearing in mind even the FTSE 100's historic average over 20 years is 6.8 or so, Steve. Nothing against Tritax as a REIT, it's just the way REITs operate. But I am kind of wary of this sector because any kind of growth usually comes with dilution that offsets almost all of it. And you need such a big starting yield at the beginning. I think it can be quite tricky.
Yes, so one of the things that they will do is if they think they're going to go through a period of slower growth in earnings, they'll push the dividend payout ratio up. So they have to pay out a certain amount of their earnings, 90% of their earnings as a dividend to keep their REIT status, which gives them tax advantages. The Tritax have already done this, Steve. Their payout ratio is all the way up in 95% now, so there's not a lot of room for them to grow their dividend beyond their earnings. So what you've got to look for now is Tritax's earnings to improve at a decent rate, and there really isn't scope at the moment for them to do that. They would point you, Steve, to the fact that they've revalued their portfolio and added about 1.52 billion to it, and say, well, we only paid 1.2 billion for UK commercial property REIT, and that's an argument that you could take on board, especially if they're going to divest some of that money. Will find its way to shareholders. But I think this is a fine report for a REIT. I wasn't even aware they'd made this acquisition. To be honest, I wasn't even aware this other REIT existed. So that's how out the loop I am with the UK REITs. But I think they need to get some rental growth through this to make it exciting. I think the dividend, Steve, is not too bad at that kind of rate. I think you'll get a FTSE 100-ish kind of return out of that Tritax Big Box dividend, providing they can keep the share price fairly stable. But who knows what's gonna happen from here? I don't know why I would rush and buy it though, when you can get a whole index's kind of level of safety over Tritax. I'm not sure what the appeal would be for me to take risk on an individual equity when you've got the FTSE 100 to the side. But yeah, this is largely an okay report. If I was a shareholder already, I wouldn't be worried about this. But as somebody looking to buy in, I think I'm in the same kind of area as you, Steve, where I think, well, it's kind of, why bother, I guess is the term I would use, Steve.
Yeah, I mean, there's plenty of smart stuff going on here. Having to dividend out your cash means you have to try and do creative things, basically, to make your balance sheet not blow up because you can't use it to pay down your debt. And they've got a nice kind of delta diagram on their latest report somewhere that points out that their cost of debt is kind of rising. They've got bits rolling off in the sort of near future. About 19% is next year. They're going to push some of that into the future, 10% more in 2027, 15% in 2028. But they are looking at what they call rent reversions, which is basically pushing rents higher. And they think this should more than offset any kind of increased debt costs. And that's good and encouraging. And it kind of better because otherwise they're going to have to find something to do with that debt. So it'll be interesting to see how they go. I agree, this isn't a badly run REIT at all, and I'm not complaining about, or at least as far as I can see, it's not a badly run REIT at all. I can't point at anything that I think is an obvious mistake here. Mostly what I take from this and some of the others that I've looked at is just how difficult it is to run a REIT, because cash is kind of nice to have and useful to do stuff with, and if you have to keep flinging it out, it's maybe nice for your shareholders, although I think a lot of them probably just use it to go and buy more shares. So the net effect in terms of what they own and what it's worth is about the same as if the company had kept it. But that's their thing to pay attention to. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.